morning, everybody. Thanks for tuning in. Today, we're talking about the Opportunity Zone Fund and investment that I'm super excited for. I've been putting a lot of energy in over the last year. So, this presentation is for investors with capital gains. We are talking about a 94 unit Class A multifamily development in an Opportunity Zone with Opportunity Zone benefits in Spokane, Washington. Our fund, for each investment, targets 15 to 20% annual average returns, and opportunity zones are a 10-year hold. Uh, Me and my partner have done 400 million of ground up development, and this is the Inland Northwest Qualified Opportunity Zone Fund. Feel free to ask questions as we go, either in the chat. Yeah, probably in the chat, and happy to answer if you're able to. Okay, just kind of disclaimers here. This is not investment, legal, or tax or accounting advice or a solicitation to buy any security. We have our PPM that goes over all that. Okay, opportunity zone summary. So, if you have a capital gain and you like real estate investing, there is nothing more tax advantageous than opportunity zones. I've looked. They're great. And so, in summary, if you have a capital gain problem, you're looking to sell stock, crypto, or having a business sale, a dental practice sale, you deploy the capital gain funds into an opportunity zone fund and a real estate project. You can reduce we're targeting a 50% reduction in that tax up front. We build the building, we take depreciation through cost segregation and bonus depreciation, so we maximize that for all investors. We refinance typically with agency debt and distribute. And then there is a tax-free, 10-year tax-free exit, which is amazing, right? This is like a major benefit that we'll go into more. And after 10 years, you can either roll the tax-free funds in the OZ fund, continue to invest in new properties, get new depreciation, compound growth tax-free, and there's no 10-year commitment after the first 10-year seasoning period. So that's awesome. Or you can take your tax-free funds for whatever you want. Okay, so our investment here is the Summit in Spokane, Washington, our real estate investment. It's 94 units, Class A. I've been working on this project, like I said, a whole year. I love this project. It's a lot of fun. It's 5 minutes from my house. We're targeting construction in Q2 of 2026, so we're almost done with permitting. We've been talking to lenders, and those are kind of the last two pieces. So, targeted rents for our apartments. We have studios, one bedrooms, two bedrooms. They're going to be 1,500 to 2,170, which is market. Our going in cap rate on constructions at a 6.75%. So much less expensive than acquiring a new apartment complex. And that's why we do development. Development spreads about 1.5%. So very healthy. We plan on being stabilized after 25 months. So 16 months of construction, 9 months to lease up, and then we will exit after 10 years. As long as the market is fair or good, we'll exit on a tax-free sale for everybody. Our development budget is 25.2 million. Our equity raise is 6 million. Our 10-year average, return projection 15 to 20%. Performance says 20, and our 10-year equity multiple is 2.5 to 3x. So 2.5 to 3 times folks' money tax free. So it's huge. So some of our investment thesis here, I love this property because it's 5 minutes from my house, which is like the nice area of town, the historic, a lot of the doctors, financial insurance folks live here. And then, on the other side of the property is the university district. So we got 5 universities downtown by the river. It's a great area. So this is just very well located. Um, we have a 12-year 100% tax abatement on the building, so that's a huge benefit to cash flow and a competitive advantage. We're serving the 20 to 39 year avatar. That's the largest demographic, young professionals, grad students. This is a great location for that. So it's in a hip, gentrified area called South Perry. It's a great place to live, a walking street. They got a bar and grill across the street. And why Spokane? Spokane's slow and steady. We continue to grow slow and steady. People love the 60 lakes within 60 miles, a bunch of great ski resorts, a bunch of great golf, low expense golf. So yeah, folks just love Spokane. Continue to add jobs. Where this submarket is like one of the wealthier submarkets in town. So average income in this area is about 109,000. So good income for affording these nice apartments. Some other value adds. There's been recent zoning changes that have eliminated density maximums, so we've been able to create a really nice, dense site here. Like I said, close to downtown, University District, South Perry. Like it's a great place to tuck into. Some of our competitive advantages, we're able to source these good locations, and then because we're vertically integrated as constructor, contractor, and excavator, we're able to implement cost controls and stick to timelines. So we do what we say we're going to do at the cost we say we're going to do it on the timeline we say we're going to do it, which is super important to me. I really like to control outcomes. So, and then we've got a great differentiated design aesthetic. This is more of a Montana type design that you see, and we're bringing this to Spokane. So super excited. Okay. Okay, so this is me and the family. We started Cochrane Capital because we wanted to create investment opportunities, do what we're doing, tax advantaged, higher net returns in the stock market. That's why I created this. By the numbers, me and my partner Wes on the construction side developed completed 400 million worth of projects. We have 240 million in development, about 784 units, mostly multifamily and townhomes. We've had three exits. The exit numbers are really good, 49% annual average return, 37% IRR. Do not expect those returns. I always go for those returns, but do not expect those returns. Always keep a conservative mindset. But I'm always optimizing everything and maximizing everything. And I'm typically the largest investor. And I'm typically the loan guarantor. So I'm highly incentivized to make things go well. So. Okay, let's talk a little bit about the key benefits and timeline of a qualified opportunity zone. The big benefits here, we'll dive into specifics, but tax deferral up front. If you have a capital gain, you can either reduce that capital gain tax or defer it. On the back end, you pay no capital gain tax or depreciation recapture tax. That's massive. And then during the project, we're taking maximum depreciation with the cost seg. So, save on taxes there. If we refinance, that's tax-free money back to investors, and we'll do that. And then quarterly cash flow distributions along the way. Here's a good quote. It's not about your gain now. So you do save money on your gain now or defer it, but it's really about the gain on the back end because your investment value has gone up so much, and that's tax free. So when you really look at the numbers, like that's the big piece. This is like a Roth, right? Like tax free on the back end. So super super huge. Been over 100 billion already invested in qualified opportunity zones. So this is massive, and then they just made them permanent last year. So you're going to see this continue to grow, become very popular, like a 1031. All right, next. General timelines, you invest capital gains into the fund this year. Um, we'll defer tax. Your taxes will be due in 2027. We'll go more into this, how we do this, but we're targeting a 50% savings in capital gain tax, which is a great savings. And then, like I said, on the back, in capital gain tax, depreciation recapture, everything's tax free. So. Okay, here's some of the math. So the OZ structure may increase after-tax returns by 40% on top of typical real estate returns. And this is the basic math here. If you're in a typical real estate investment, we do a lot of these too. You got a capital gain of $1 million. Usually you're paying 200 to 238,000. So your net investment after that's 800. Just using a 2.5 times equity multiple at 10 years, more of a conservative number here, $2 million value. And then you got a big capital gains tax again on that sale. So your net value is 1.76 million. Okay, 1 million to 1.76. This is how real estate typically works. We try to do 1031s if we can on the back end for folks who want to try to help with this one. But OZs are great. I mean, clean. You put the million in on this model shows no capital gain tax. There is a way to defer for 5 years if the timing's right. So we can chat more about that, but it'd be about, let's say 100K, just to keep it simple. Nothing on the back end. Oh, there's the 100K we were talking about. So your net return, I mean, that's a 31% increase just on capital gain tax from 1.76 to 2.4 million. So the OZ is quite strong if compared to a non-OZ project. So anytime you have a capital gain, though, you got to have a capital gain to do OZ. So this is great, like I said, when you're selling stocks, when you're selling crypto, or you have a business sale. I wanted to add in depreciation recapture. So to kind of show how that works. So you can kind of see same thing. This is the benefit after 10 years on the typical. You get this depreciation benefit, less depreciation recapture later on. You're back to the same number. But with the OZ piece, you could add that back in. So that really increases your net return 40% um, projected. You know, numbers aren't always exact, but I want to give you guys some really strong math. So if you like investing into real estate, and you've got a solid real estate project, right? Like, why not do OZ? So, Andy, welcome, buddy. Um, okay, so is this for me? You have a capital gain, you like to invest in real estate. If yes to both, there's no better program to be in than the OZ, hands down. If you're coming in late, we will send out a recording for everybody. A couple details with zone one. So any capital gain that goes into an investment this year is opportunity zone 1.0. Anything next year is opportunity zone 2.0. So for this project, we're targeting construction in Q2 here. So the deadline on this one's probably going to be Q2 for investing into this project. We're targeting a 50% tax savings from a reappraisal. So this is common in like Roth conversions where you reappraise the assets after you put the money in. So, we all put our money in, but like in December 31st, when this tax is calculated, we're going to be like mid-construction, right? We're going to have, let's say, 6 million in equity, but we're going to have like 19 million in debt, right? All we have is some dirt and a foundation and maybe some sticks coming out of the ground. So there's more equity than debt. And as investors, like, you don't have control over the project, right? So you get a discount the value because of lack of control and then lack of marketability. I mean, this is a 10-year commitment. And so the math shows there's actually like a 60 to 65% reduction in tax, but more conservative, we're targeting 50%. So instead of your capital gain tax on that million being 200 to 238, we're targeting cutting that in half. So that's a great upfront tax savings. The remaining taxes will be due April 2027, and like I said, the OZ adds about a 40% after-tax return. So um, at the end of the 10 years, so at the end of the 10 years, as long as the market is like fair or good, we'll sell this asset and then you'll have cash tax free. You can either take that and do whatever you want with it, or you can roll it in the fund. And the great thing about the fund after 10 years is now it's seasoned. So no longer do we need to hold assets for 10 years. We can hold an asset for 1 year. We can hold an asset for 3 years. So we can continue to compound our wealth tax free and take the depreciation and then not pay depreciation recapture or capital gain. So after 10 years, I haven't seen a better tax hack than this. This is really going to be strong for people. So the key is get the money in, have it seasoned after 10 years, and then you're going to have a lot of optionality on some tax minimization strategies after 10 years. Opportunity zone number 2.0. This is the one that's permanent now, starting January 1st to 2027. This isn't directly related to what we're talking about today, but I did want to plant seeds. We're doing an OZ project probably about every year. And so the differences here on OZ 2.0 is instead of 50% cut in capital gain tax on your original capital gain, you get to defer your tax for 5 years. So you still got to pay it, but you get to pay it 5 years later, and you get a 10% reduction. So that's the new program. Well, you can do a lot in 5 years, right? You can compound that money, maybe double it, right? So why not take that 5 years? Um, so that's the new program. There's other changes. There's added benefits for rural sites. There'll be some new locations. And then each fund has 30 years. So you can compound 30 years tax free. So this is, and take the depreciation, like I said. So we'll get more into this in the future, but just wanted to give you a heads up about this is now permanent. You're going to hear a lot about opportunity zones you know, as long as this program is in existence, and right now it's made permanent. So this is going to become really popular in everybody's vocabulary over the next few years. Okay, briefly, why real estate? If you guys follow me, you kind of know these slides. This is the basics of like a well-bought property. Not sure why there's an echo all of a sudden. Um, you get depreciation, you get your appreciation, you get your loan pay down, cash return, total return 16% minus, I like to use 4% for inflation. I feel like the numbers, this is more reality what I see when you look at like cost of electricity, cost of food, everything goes up quite a bit more than 3%, like they have to say, or 2.5. So net return on real estate, 12%. Stocks, I was an honors finance major, typically 8%. The last 10 years have been more like 10%. Oops. And minus inflation, about 4 to 6%. So usually, 2 to 3 times if you buy real estate right? Not off of Crexy or something that's been through the brokers. Yeah. So, and then if you're looking at your net wealth curve, if you're putting 200K in for 25 years, earning 16% on real estate, this is what you'd have. If you're doing stocks at 9, this is what you'd have. So about triple. So, stocks are illiquid, so it's a longer commitment period, but you are building up that net worth and cash flow with real estate. Stocks I like because they're simple and liquid, right? You just dollar cost average. Yusuf, welcome. Okay. Oops, come on. There we go. So here's a simple portfolio, right? Your core business is where you're really going to build wealth. And then you can, keep a quarter of that as you're taking money out of here into real estate, build up that net worth, that nest egg faster, and then, keep things in an index fund if you want for the liquidity. So however you want to do your portfolio, but this is a general wealth building strategy. So, okay, so we do have a housing shortage right now. I mean, you guys have heard that in the media. So, that gap is still there. Sometimes you hear 5 million units, 3 to 5. That's a real issue. Supply has been dropping, which is great for us. Less competition in the market. So new supply, this is like new construction of multifamily is dropping. So less competition for us. But the big thing here is the gap between the cost of owning a home, like a starter home, and the cost of renting. So, like in our market, the cost of like buying a new home, like every month, like insurance and mortgage is around 3,500, right? And we're bringing units, studios at 1,500, 2 bedrooms at 2,170. So there's a massive gap between renting and buying. which creates a good market to be a landlord, right? If the cost of buying is very close to the cost of renting, people are going to typically choose to buy, right? They want that American dream, but if there's a big cost difference, they're typically going to rent. That middle section is going to rent. Um, so this is one of the reasons I love multifamily. Yeah. So. This is a little dated. I don't know if I want to talk about this. I'll probably delete that slide. Okay, investment overview. So target annual average return 15 to 20%. Pro forma showing 20% on this one. That equals a net equity multiple of 2.5 to 3. So this is like how much your investment grows over the 10 years, right? So if you put in a million, you got 3 million at the end. We silo our investments. So when you're investing in this opportunity zone fund, you're only investing in one property. So we like to say, hey, I want to invest in this property. Great. We're all in this together for this property. Investment here is growth. Hold period's 10 years, minimum investments, 100K. When it's OZ and it's capital gain, you tend to have um, larger amounts of money to invest and to try to tax mitigate, right? So these tend to be larger investments. I think average investment size is close to a million right now. Sponsor. So, I'm always like 10 to 15%, 10 to 50% of investments. I usually start around 50. And then as people come in, I tend to drop down, just depends on the project, 10 to 50% is where I usually end up. And then I personally guarantee all the loans. So, number one thing on any project is not the project, not the market, it's the jockey, right? That's the most important thing. And I think it's important for people to know that like I have the most to gain and I personally gain all guarantee the loans. I also have the most to lose. Got my name attached to 19 million in debt on this one. So I'm highly motivated to make this very successful. So how an OZ fund works, basics. We acquire the property, we improve the property by building a building on it, we stabilize it by filling it up with tenants, usually about to 93 to 95% filled. And then we also do a depreciation cost segregation with 100% bonus depreciation. So we get you as much tax benefits up front as possible. Then we start cash flowing this thing, distributing quarterly. Um, after 10 years, we sell the property, and then you have the option to continue to compound your wealth tax free or uh, just take your funds, whatever works better for you. So,
Is step four assumed to be in the first year, Josh?
great question. So, no. So, on this one, construction timeline on this one, 16 months. So if we start in Q2, 16 months later, we have the building built. And so we'll do depreciation, cost segregation at that point, get the tax benefits for everybody. And then typically for 94 units, that typically takes us about 9 months to get that building to 93 to 95% occupancy. So 16 months for construction plus the 9 months, you're looking at 25 months. At 25 months, then we do that refinance with agency debt. Um, and that's tax free to folks. And then we start cash flowing.
Thank you.
Oh, my pleasure, Andy. Thanks for asking. So timeline, yeah, Q2 2026, we'll start construction, 16 months of construction, and then Q3 2027, construction will be complete. We'll do that depreciation for everybody, and then a 9 month lease up, and then we'll refinance tax free to everybody. Um, Refinance tax free all depends on lots of factors. But we always try to maximize this because it's tax free and it's money up front. Then we do quarterly distributions, and then after 10 years to get that OZ benefit, that no tax, right? That 40% boost to returns on top of our normal real estate projects. You got to hold for 10 years. And so as long as the market is fair or strong, we sell the asset and you can continue to roll funds as we buy new assets and they no longer need that 10-year hold period. I think it's like a 367-day hold period. So we can either do investments that are in shorter timelines if we'd like, or you can take your funds tax-free and do whatever you want with them. So it's a really nice structure. Sources and uses on this one, looking right about 6 million. I think me and Wes are in about 3 right now. Debt 19.2. I've got about 9 lenders I'm talking to right now. I like to really compare everybody and see who's hungry. I use a lot of the same lenders, but you really got to send it out there so you get the best debt terms. And then land, about 3 million on this one. Hard costs, 18 million. So that's all the vertical construction, soft costs, architectural, permitting, all that kind of stuff. Engineering, and then finance costs, interest costs while we're getting this thing going, and normal fees. So $25 million project. Here is a site plan. If you haven't looked at these before, you kind of got the entrance here. You've got the first building here, which will be 47 units, 4 stories. You've got the other building here, and then we've got a cool clubhouse. I'll show you that. And then we've got a bunch of parking here, and then a parking lot here as well. So we'll have carports that we'll rent out. We'll have some garage units that we'll rent out, and some EV stalls as well. So for the aesthetic here, I really wanted to get a more peaked roof design that you don't usually see here. This is more like Montana, Bozeman, Whitefish type styling. I really like the wood accents. It really makes it feel more like home and more Northwesty. So that's also a design element that's important to me. Another one is the clubhouse. I always want the clubhouse to feel like a coffee shop, and that's a happy place for most people. So that's an important design element. We also have a big gym in here too. That's another important one. And we've got a beautiful view. This is called the Summit for a reason. We're on top of a hill that overlooks downtown, Mount Spokane. I mean, it's a beautiful place. This is kind of our design aesthetic for the inside of the clubhouse. That coffee shop feel. You can see it's just a very comfortable place to hang out. Risks, biggest risks are always market deal sponsor. The market, interest rate spikes are a risk, as you've seen. Our current administration is not interested in those. So I think we're good for a few years. I mean, there'll be ups and downs a little bit, but I think we're pretty good. It's looking pretty good right now. Occupancy rates, right now in this market, we have great occupancy rates, 94, 95%. So feel good about that. The rent rates are strong. Another friend of mine just released a building not too long ago. They filled it up quick. They got great rents. Those are the rents we're using actually. I look at all the comps, but that one was pretty similar. And remember, we're going to be open, yeah, about maybe 18 months after they opened, right? And so if I'm using their rent rates, usually rents go up by about 3% a year. So our rent rates will probably be even higher than I have pro forma. Concessions, are people giving concessions in the market? There's a little bit of concessions in our area, not a ton. Rent controls, there are rent controls in Washington State now. They're 7% a year, but they don't apply for the first 10 years. And the strategy there typically is just raise your rents 7% a year. And then you don't have to worry about like inflation and that kind of thing. So I'm not too worried about that. The deal, buying for appreciation. We're not buying for appreciation. We're buying for cash flow. Inadequate cash reserves. When we refi with agency debt, we always make sure to have strong cash reserves. I want to sleep at night, you want to sleep at night. So got to make sure you have that. And then variable rate debt. We always do our agency debt, which is like 30-year fixed, right? Which is fantastic. And it's usually, about 100, 150 basis points less than like other loans. So like right now, I had a friend just do like a 250 unit apartment building at like a 4.5%, right? I mean, you don't see 4.5% rates outside of agency debt. Um, Sponsor, so I do have like an local operator if I were to die to take over, and then I also have a fund manager to take over. Both great people, and so there's that. And then problem solving, this is what I do. Like every day, I love it. We just like, what are the challenges and what are the solutions? Let's get after it. I think we talked about all these mitigations already. We're also like I said, 12-year tax exemption on the buildings, which is great for cash flow. Yeah, if anybody has questions, stop me anytime. So we're almost there.
Yep. Risk also. What if you or someone else needs a bunch of their money early for some reason, or
Yeah,
default, right? They or bankruptcy in any of the investors.
yeah. So how this is typically handled is one is like this is an OZ um, project, right? And so just like with an IRA, right, or a 401k, if you take your money out, you're not going to get those tax benefits. Make sense? So on that side of things, there's that. And then how do you get your money out? So, typically, this is like a closed private real estate investment. But if you're going through like a situation, a divorce, bankrupt, something like that, where the funds need to be, you need the funds. Basically, you just reach out to me and either myself will replace you or we'll start reaching out to the other investors in the deal to replace you. I mean, these guys usually know this deal pretty well and how it's going, or we look for an additional investor.
What if the primary sponsor needs his money back and that's half of it?
The primary sponsor needs its money back. Um, I don't think I'm not interested in needing my money back. So this is like an investment that's
Hard
legally
questions on the
secured
risk
and protected.
slide. So
What's that?
hard questions on the risk slide. So
Yeah, yeah. No, this isn't a hard question. It's just um like I just don't need my money back, right? This is a encapsulated investment. So this won't be something that I'm looking to take out money out of. So
okay. I do
yeah.
have another question. I don't want to dominate.
No, no, these are great, man. I'm sure everyone else has these questions, or once they hear them, they're like, oh man, that's a good question. Go for it.
Uh, Quarterly distributions. Do you have that modeled?
On these, yeah. So quarterly distributions, if you like you're wondering how like when it's going to happen or how much.
Yeah. What is that? What do you think the growth would be over time at um, cost of money and rental increases?
hmm So when you're looking at a 10-year horizon, you perform out the beginning based off of your numbers that you have today, right? Those are more accurate. And then as you get further out, all you're using is like historical averages, right? You can't use anything else. So the numbers here are pretty vanilla, and in every pro forma you're going to see are going to be pretty vanilla at those points. So the first question is what are quarterly distributions going to be? As I already mentioned, I am going to maximize the cash out refi. Okay. And when you maximize the cash out refinance with the agency debt, the amount of money you can take out is based off of one number. It's called your debt service coverage ratio. Okay. So typical banks like locally 1.25 debt service coverage ratio, typically agency debt between 1.17 to 1.2 debt service coverage ratio. Okay. So we know we're going to max out cash refi because it's tax free to everybody. It's awesome, right? So we're going to max that out. So when you max that out, you have the math there. It's like, depending on the debt, it's 1.17 to 1.2 debt service coverage ratio. And when you run the math on what is that distribution after the cash out refi at that 1.7 to 1.2, it's typically around 5%.
Okay, cool. Thank
So
you.
it's not based off of market. It's not based off of anything we do because all of that gets incorporated into the cash out refi. That's what goes up and down is the size of the cash out refi. Good
And that's a 5% annualized.
to start, right? And then each year after that, you just look at historical norms, right? Historical norms are a 3% annual average increase in rents, right? And a 3% annual average increase in cost. Okay. I have a slide on this, which is really great. I did on my last webinar, but on these projects, like on this one, we're probably going to be, because of the tax benefit for the first 12 years, we're probably going to be 80% like revenue, 20% cost. Okay. And so 80% growing at 3% grows much larger than 20% growing at 3%. So that's what increases cash flow over time. I have a really beautiful chart on this I can show at the end. It's in my other presentation I can show you. But so that's why, like, when you start doing the math, it goes 5, 6, 7, 8, 9, 10, right? And when people always ask about, like, how do you create cash flow, it's long-term holds in real estate. I mean, you look at all like the little old ladies whose husbands have passed away and they've owned these apartment complexes for 20, 25 years. They haven't even paid off the loan yet. And their cash flow is like three times what it was at the beginning, more than that. I can show that slide.
All right, thank you.
Yeah, great questions. Okay, so 400 million in ground up experience. Mostly townhomes and apartments. That's what we tend to stick to. Um, so we got myself, Wes. He's my construction partner. He's awesome. He's like an operator, just so solid, never gets emotional, just gets his stuff done. He's great. We've got a very strong civil engineer, Todd. He knows everything. He's been here forever. Drew, super sharp. He cracks the whip. I love that. He gets things moving. A lot of different lenders. I just put a couple here. And then on the OZ fund, here's like our accounting and legal folks. So this is institutional built. These are all institutional terms. So on this project, I think we'll just end it at like around 6 million in equity, like I said, and then Q2 investor redemption option, like I said, not applicable in OZ funds typically, but if somebody really gets stuck, like I'm here to help you, and I always find ways. We'll do our best to get you some funds. Distributions, like we said, not until stabilization. Actually, this should be 100K for these. Um, Asset management fee, this is like institutional acquisition, 0.5%. So the keys here are you're trying to tie performance to um, you're aligning incentives with investors, right? You're tying performance, your compensation to performance, not upfront. There is a little bit of admin fee, so the larger the investment, the less the admin fee. Okay, so pretty simple here. You got a capital gain. We put it into the fund, we build the building, we get depreciation, we get refinance, we get distributions, 10-year exit, the OZ structure. If you run the math, it increases after-tax returns on the real estate investment by about 40% between the capital gain and the depreciation. So, pretty awesome. Okay, questions? Andy, feel free, dude. I love questions.
I've already peppered you, so I'm
Steve, you're very sharp. Anything pop up for you?
I'd look at fees a little bit more just to kind of digest those. And I think
Yeah,
your slide, you have a 50K min on that one, and you had 100K on one of the other ones.
it should be 100K.
Okay.
I just didn't update it. But fees, we can go back. We move all these little Zoom tabs.
So if someone comes in at your minimum, they'd be getting hit with the 2% plus another 2%. So 4% would be,
The Yes, the acquisition fee is built into the project cost, right? So that's implicit in the project.
yeah.
I mean, you see acquisition fees like, 2 to 5%, right? So 0.5 is like the smallest possible that you'll see.
Yep.
Um,
And the performance is we keep the first seven, and then above that, eight, nine plus gets the 30%.
yep,
Okay.
yep. Um, yeah, then asset management, and this is typical for an OZ fund. Um, I just emulate like the biggest guys out there, who've done very well, who just like not done well, but more like I admire, right? I just think they do a fantastic job, and so I just don't reinvent the wheel. Um, and then, yeah, I mean, we have a bunch of legal fees up front, right? And accounting fees. So this just, ballpark hopes to cover it. Um, but it's a lot less work with bigger investors. So like the bigger investments get incentivized. So like I said, our first couple investors were in this tier. Um, so, okay. Other questions? Andy's an engineer guy, so he's got that engineer brain.
Yeah, I like data.
Yes, good questions. Steve, any questions for you, bud? Gary, Jonathan. Jonathan's an RIA, so he's real sharp at this stuff too. So nothing from Steve.
Getting sharper. My only question is kind of along those lines. If we were to, I don't know, say have five investors and they each put in two, would we qualify for that 1% upfront, or is that really at the individual investor level?
Yeah, sure.
Okay.
Yep. I'm not about upfront fees. I'm just trying to cover the the accounting and legal costs. Uh, for me, it's all about eat what you kill. That's my culture. That's who I am. So, um, that's how my brain goes. And like I said, I'm usually by far the largest. Well, across all the investments, I mean, I don't know, 30% of the investments. So I'm highly incentivized. And the debt, right? I'm personally guaranteeing all this stuff. So that's a big carrot to not to make sure everything goes well. So I'm all in on this stuff
So asset management fee is annual, acquisition is one time,
yeah,
performance will be
at
at
the end.
distribution quarterly, and the rest of them are upfront.
Yep.
Okay.
Yep. Yep. So um, this is very institutional. If you kind of look this up, this is pretty much the
Yep.
OZ
I was just trying to
institution.
make sure I understood. Gary has a question for you in the chat.
How is it designated and QOZ? So yeah, so there's all the opportunity zone tracks, right? So this project is in a OZ 1.0 tract. So we set up a fund, and the Opportunity Zone Fund is an LLC. That's where everybody funds go. And then I set up a Opportunity Zone Business LLC that invests in the property itself, which is within the zone, and that gives us the benefits. I think that was your question, Gary. But if it's not, um, please specify, and I will answer for you. So, Sunny Yusuf. Zoom user, anybody, any more questions? So, yeah, I think at the end of the day, it's like when I have a capital gain, I either don't want to pay it or I want to defer it or I want to shrink it, right? And so what's out there? And so this is the best solution I found when I'm selling stock or selling a business to shrink that capital gain or defer it. And if I defer it, I compound my growth during that deferral period, right? So over a 5-year deferral period, just like for me personally, usually I double the value of something, right? So if I was going to pay $1 million in taxes, now I've taken that million into 2 million, and I can either find another tax strategy in 5 years to not pay taxes, or I can just keep 1 million and give 1 million to the IRS, right? When originally I would have had to give all million to the IRS. So I love these capital gain strategies that the feds give us. And then on the back end, I mean, that's even a bigger deal, right? If you're already going to invest in real estate, right? You're already like, this is where I want to add this to my portfolio. I want the diversification. I want that increase in yearly yield, like on average as an asset class. Then it's like, why not do an OZ if I have a capital gain and get that extra 40% with no tax on my back end? I mean, that's no handcuffs, right? That's super freeing. So I think that would be the summary. So, Andrea, I believe you put a couple notes in if you want to set up a call, chat more, or if you have questions or whatever, you can always just text me. I'm happy to answer any questions. So, um, any final questions today? Okay, well, this OZ project will, like I said, we're almost done with permitting, and we're working with the lenders right now. So we're targeting to have all the investments in Q2 and get started on construction. My pleasure, Steve. And we'd love to have you investing alongside us and growing wealth together and utilizing the tax benefits that the federal government wants us to utilize. So thanks for tuning in, everybody.
Thanks, Josh.
My
Thank you.
pleasure. Take care, guys.
All right. Bye.